Today, we will talk about investing for dummies. Step 1. Have a fully stocked emergency fund? Probably the scariest scenario in the investment universe is watching your investments fall in value at a time when you need the money for other purposes. But like everything else when it comes to investing, there's a fix. It's called an emergency fund. An emergency fund is a completely safe, completely liquid financial account that enables you to access the funds anytime you need them and on very short notice. There are two major purposes for an emergency fund: to have ready cash to cover an unexpected expense and to prevent you from needing to liquidate investment assets to cover that expense. Put another way, an emergency fund serves as a protective buffer between your budget and your investments. It prevents you from having to liquidate investments at prices that might lock in a permanent loss. What's sleeping money? The financial markets don't always behave the way we expect them to. Sometimes they languish for what seems like forever. Other times, there's a lot of volatility, with the market swinging back and forth in unpredictable patterns. And sometimes there's a bear market, causing stocks to drop for several years. If you got money sitting in a safe emergency fund, you won't be as concerned about the ups and downs of the market. You'll be able to sleep at night. Where should you hold your emergency fund? We like online banks that pay high rates on savings, money markets, and certificates of deposit, CDs. Examples include CIT Bank, Synchrony Bank, BBVA, formerly BBA Compass. Any of these banks keep your money safe, completely liquid, and pay interest rates well above local banks. Step 2. Make sure your debt is under control. There are some who will say you should start investing no matter what your financial situation is, even if you have a lot of debt. This is not a completely ridiculous concept. It has to do with the time value of money. The sooner you begin investing, the more time your money will have to grow. Simply put, you'll have more money accumulated if you begin investing at 25 than if you start at 40. That's the argument to begin investing no matter what your financial situation is. But while that strategy makes sense in a lot of situations, you also have to look at the math. Consider the following. Interest. The average interest rate on credit cards is 17.14%. Returns. The historic return on the S&P 500 is about 10% since 1928. Reality. Even with 100% of your investments in the stock market earning 10%, you'll be losing 7% each year with an equivalent amount of credit card debt. If you have a lot of credit card debt, you can see how this will work against you. That's an arrangement you're doomed to lose. Now, that doesn't mean you need to be absolutely credit card free. If you have relatively small balances, there's no reason to wait until you pay off the last dollar. But if you have several $1,000s in credit card debt, you must consider what a losing proposition that is. The better strategy will be to pay off the bulk of your credit cards before investing. When it comes to investing, credit card debt is like a backdoor margin loan, but at rates so high as to defeat the purpose. What about other types of debt? Other types of debt, like student loans and auto loans, are trickier. Student loans can run for 10, 15, or 20 years. That's too long to wait to begin investing. And car loans make sense because they are secured by an asset that's used to help you earn an income, your car. It's long-term debt, like student loans, and it's secured by an asset that provides a direct benefit, similar to a car loan. If you wait for these loans to be paid off, you may never begin investing. Step 3. Start small. Probably the biggest reason people don't begin investing sooner is a lack of money. But in today's investment universe, a lack of money isn't a serious problem. There are any number of investment platforms that will enable you to begin investing with very little money, or even none at all. Betterment. For example, probably the best known of all robo-advisors is Betterment. You can sign up for an account with them, and you don't need any money at all. You can fund your account gradually through regular monthly deposits. If you can contribute at least $100 per month, you'll be surprised how quickly the account will build up. And as investment earnings increase your account value, you'll begin to see the power of that time value of money concept in action. Acorns. Another investment app that's become increasingly popular and will also enable you to begin investing with no money is Acorns. It's a smartphone app you attach to your bank account or credit card. For example, let's say you purchase a latte at Starbucks for $4.50. The app will charge your bank account or credit card $5 even. $4.50 will pay Starbucks, and 50 cents will go into your investment account. What's more, the investment account is a robo-advisor. As money goes into the account, it will automatically be invested in a diversified portfolio. From there, it will be fully managed, including periodic rebalancing to maintain the asset allocation, as well as reinvestment of dividends. This is also how Betterment works, so you really can't go wrong with either account. With each, you're starting very small, then building up over time. Perfect. Step 4. Diversify your investments. A common mistake many new investors make is putting all their money into a very small number of stocks, or maybe even one. The theory is if that one stock takes off, you'll become an instant millionaire. Sorry to burst your bubble, but that only works on TV. In the real world of investing, you need to build a diversified portfolio. That means owning many different stocks, spread across different industries. You'll also want to counter your stock holdings with fixed income investments. These will typically consist of bonds, but it could also be CDs held at an online bank. For a small investor, it can be very difficult to diversify. After all, it takes a lot of money to buy a lot of different stocks. But that's another problem the investment industry has overcome. We've already discussed robo-advisors like Betterment and Acorns. They'll automatically create a balanced portfolio of stocks and bonds for you. This will spare you the trouble of having to create a portfolio yourself. And since you're investing flat dollar amounts, even a small investment can be spread across literally hundreds of different investments. Step 5. Consider a robo-advisor that lets you choose the investments. Eventually, you may get the confidence and knowledge, so you feel comfortable selecting at least some of your own investments. If you do, there's an investment app for you. M1 Finance is a robo-advisor, but one that will give you a choice as to what you will hold in your portfolio. Here's a quick breakdown of what M1 has to offer. Minimum. With as little as $500, M1 creates you a theme-oriented portfolio. Portfolio, referred to as pies, they are comprised of stocks and exchange-traded funds, ETFs. Advantage. You can choose the type of pie you want to invest in from 60 pie templates, or create your own. Pies can be based on a specific investment sector, or even a certain group of stocks. Automated management. M1 then takes over and manages your portfolio for you. You choose your investments, but they handle the day-to-day management. Step 6. Understand what you're investing in. Once again, it has to be emphasized that you should use robo-advisors if you're a new investor. The advantage with robo-advisors is that you don't need any investment knowledge whatsoever to participate. As a new investor, you should never invest in anything you don't understand. The advantage with robo-advisors is that they will both design and manage your portfolio for you. That's especially important when you're just starting out and don't have much capital to invest. But eventually, you may want to begin do-it-yourself investing. If you do, be sure to ease into it slowly. It may be best to start with a base of investments in robo-advisors. Or you can even consider holding 1 or 2 mutual funds or exchange-traded funds. Each represents a portfolio of dozens or hundreds of stocks, so you don't have to get involved in either the selection or the managing of those securities. Beyond a robo-advisor or a fund or two, you can open up a self-directed account with a diversified brokerage firm. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.